The last time, we unpacked Strata Critical Medical Inc., SRTA. Today, we're definitely shifting gears, moving into the aerospace aftermarket. So get ready for a focused financial look at AerSale Corp, ticker ASLE. We've got the data, the reports, everything compiled. And our goal here isn't just to read numbers, it's to really find those key insights.
That's exactly right. Our mission for this deep dive is simple. Give you a comprehensive, objective view of AerSale. We'll break down the business itself, its financial health, get into the valuation details, look at who owns it, and cover the latest news. Really trying to pull out what's truly important for understanding this company.
Okay, let's unpack AerSale. So they're basically a big player in keeping older planes flying, right?
Yeah.
Aviation aftermarket products and services. They sell, lease, exchange used aircraft, engines, components, and they also do maintenance, repair, overhaul, engineering work.
Exactly. They operate mainly through two segments. First is asset management solutions. That's actually their biggest revenue generator. Think buying, selling, leasing those big assets like planes and engines. And the second is tech ops, which is more the hands-on maintenance, repair, and engineering side for aircraft and their parts. Founded back in 2008, based down in Doral, Florida. Employee count is somewhere between, let's say, 630 and 700, depending on which source you check.
Got it. So they're pretty integrated in that whole aftermarket life cycle. Now let's talk value. For anyone looking at future potential, this is key. We're going to start with AerSale's intrinsic value, specifically looking at it through a discounted earnings, or DCF, model, what the company might be worth based on future earnings.
Okay, so running the numbers, as of September 3rd, 2025, this discounted earnings model gives us an intrinsic value for AerSale of $2.98.
$2.98.
But the current market price is what, $8.46?
Exactly, $8.46. So when you compare the calculated intrinsic value to the market price, the margin of safety comes out as a significant negative 183.56%. That's a huge negative margin. That alone would probably scare some people off. But there's a catch here, isn't there, about the model itself?
There absolutely is, and this is really important. This discounted earnings model, it's really only suitable for companies that have a high business predictability rank. Businesses with stable, forecastable earnings. For AerSale, its predictability rank is officially not rated.
Not rated. So what does that really mean for this $2.98 number?
It means you have to take that number with a huge grain of salt. Seriously. Because the business's predictability is low, or at least unrated, the projections this DCF model makes are inherently less reliable. We can run the calculation, sure, but the result is more for demonstration purposes. Trying to forecast earnings accurately for a business like this is just very difficult.
Okay, so for you listening, the big takeaway here is don't just grab the number. You have to understand the assumptions and, critically, the limitations of the model, especially when predictability is low.
Precisely. And just for context, the model used default parameters, an 11% discount rate that's based on the 10-year Treasury, plus a 6% risk premium. The initial growth rate used is 5%. Now, that's actually capped at 5% because AerSale's average EPS growth, excluding non-recurring items, over the past 3 years was negative 48.8%. Really deep negative.
So the model kind of defaults to a conservative positive instead of projecting that huge decline continuing forever.
Right. It uses 5% for a 10-year growth stage, then drops to a 4% terminal growth rate. But again, the model works best for consistency, not for businesses that are cyclical or inconsistent like this one can be. The inputs are shaky, so the output is shaky.
Okay, that makes sense. So given the uncertainty in projecting the future, let's ground ourselves in the here and now. What are the current numbers telling us about AerSale's financial health and its recent performance?
Right, let's pivot. As of September 3rd, 2025, the last close was $8.46. Market cap is sitting around $349 million. Interestingly, the enterprise value is higher at $542 million. That difference mostly reflects the company's debt minus its cash, giving a fuller picture of its total value.
And how has the stock actually been doing?
Performance. It's been quite a ride, a real mixed bag. Over the last year, strong performance, actually up 64.27%. And even just over the last month, it's jumped 38.01%. But then you look at the last week, and it dipped negative 6.00%. Volatility is definitely part of the story here.
64% up over the year, but down 6% last week?
Yeah.
Wow. The 52-week range confirms that too, right? High of $9.12, low of $4.53.
Yeah, exactly. That range from $4.53 up to $9.12 really shows the significant swings investors have had to navigate.
A true roller coaster, like you said. So with that kind of price action, what about the underlying profitability and valuation ratios? Do they look more stable?
Well, let's see. The trailing PE ratio, based on past earnings, is quite high at 59.87, suggests either low recent earnings or high market expectations, maybe both. But then the forward PE, based on estimates of future earnings, drops dramatically to 12.72.
12.72. That's a massive difference from almost 60. What does that imply?
It implies analysts in the market are expecting a very significant rebound in earnings per share. This is also reflected in the PEG ratio, price earnings to growth, which is 0.67. A PEG below 1 can sometimes be seen as attractive, suggesting the price might be low relative to expected earnings growth. If that growth happens, of course, other ratios. Price to sales is 1.14 and price to book is 0.96. Both seem, fairly reasonable for this kind of company.
Okay, but here's where it gets wild for me. Trailing EPS is just $0.14, but next year's estimate is $0.67. That fuels this incredible EPS year-over-year TTM growth figure of, what, almost 2,400%?
Yes, 2395.16%. It's an enormous jump.
How do you reconcile going from nearly 50% growth to plus 2,400% growth? What's driving that potential turnaround?
That's the million-dollar question, isn't it? And yeah, it is a head-snapping contrast. It could mean the company's hitting an inflection point, maybe overcoming past challenges, benefiting from better market conditions, airlines needing more parts or services. But it also demands a closer look. Is this jump driven by core operations improving, or are there one-off things, like maybe a big asset sale boosting recent numbers, or maybe aggressive cost-cutting? Given the cyclical nature of aerospace aftermarket, big swings aren't impossible, but this magnitude. It really highlights why that not-rated predictability is so relevant. You need to understand the why behind the numbers.
Makes sense. What about margins? How efficient are they at turning revenue into profit?
Looking at margins, the gross margin is pretty solid at 30.44%. That's respectable. However, the operating margin is only 3.65%, and the net profit margin is even lower at 1.86%.
Whoa, so from 30% gross down to less than 2% net.
Yeah, it shows that while they get a decent margin on the initial sale or service, a lot of that gets eaten up by operating costs, interest, taxes, the cost of doing business. It suggests maybe high overheads or tough competition squeezing the bottom line.
Okay, shifting to the balance sheet. How are they looking on liquidity? Can they pay their bills? And how much debt are they carrying?
On liquidity, the current ratio is strong, 3.87, so plenty of current assets relative to current liabilities. Seems healthy short term. But the quick ratio, which excludes inventory, is 0.76, below 1.
Meaning if they had to pay bills without selling inventory, it might be tight.
Potentially, yes, since inventory like spare engines or aircraft parts can be a big part of their assets and might not be instantly sellable. So overall liquidity looks okay, but that quick ratio is something to watch. On the debt side, the debt to equity is 0.36 and long-term debt to equity is 0.35. These are pretty manageable levels, suggesting they aren't over-leveraged, which is good.
Okay, so leverage seems under control. But what about returns? Are they generating good profits from their assets and equity?
That's where it's less impressive. Return on assets, ROA, is low at 1.05%. Return on equity, ROE, is 1.50%. And return on invested capital, ROIC, is 1.16%. These are all quite low, indicating that despite manageable debt, they aren't generating very high returns on the capital they've deployed. It suggests maybe lower efficiency in using their assets to generate profit.
Right. So moving beyond the financials themselves, who actually owns AerSale? And importantly, what have insiders, the managers and directors been doing with their shares recently? That can be a telling signal.
Good question. Ownership is interesting here. Insider ownership is quite high at 31.42%. That means people running the company own a big chunk. And institutional ownership is also significant, 52.11%. So big investment firms are involved too. High insider ownership often aligns management with shareholders, which is generally seen positively.
But what's the recent activity been like? Are insiders buying or selling?
It's actually been a bit of a mixed picture lately. We've seen some proposed sales. For example, Officer Benjamin Thomas Sherhart filed to sell shares in September 2025 around $8.40, and also back in July 2025 around $6. Martin Garmendia and Enrique Pizzi, other officers, also had sales earlier in 2025.
Officers selling as the price goes up. Okay. But what about buys? Any insiders putting their own money in?
Yes, on the flip side, there have been buys. Director Judith Ann Fetter bought shares in August 2025 at $8.51, so quite recently and near the higher end. And perhaps more significantly, co-founder Nicholas Finazzo made some substantial buys back in September 2024 at lower prices, $5.36 and $4.86. Frederick Craig Wright, another insider, bought around then too.
So you've got officers selling near recent highs, but a director buying recently, and the co-founder making big buys when the stock was much lower. How do we interpret that mix? Does the founder's bet outweigh the others taking profits?
That's the nuance, isn't it? It's complex. You could argue the co-founder's buys at lower prices signal strong long-term belief, maybe seeing deep value back then. They know the business inside out. The director buying recently near the high is also a vote of confidence. The officer sales. Well, they could be for many reasons: diversification, personal finances. It doesn't necessarily mean they think the stock is topped out, but it's something to note. It suggests maybe differing time horizons or perspectives internally, but those founder buys back in 24 are definitely a point investors would focus on.
Okay, bringing it all together now. Let's let outside the company's filings. What's been happening in the news regarding AerSale, and what are the analysts saying?
There's been quite a bit happening. In August 2025, they brought in a new general counsel, Paul Heschenberger. Signals maybe a focus on strengthening leadership, governance, and as we mentioned, those Q2 2025 earnings reported August 6 were positive, beating expectations. That caused that stock jump. Headlines pointed to better feedstock access, meaning getting the used planes and parts they need, product expansion, and better margins. Seems like core operational improvements there.
So positive recent news. What about earlier this year or last year?
Earlier in 2025, it was tougher. Q1 results in May actually missed revenue expectations and showed a net loss. So, inconsistency again. Going back further, Q4 2024 results reported in March 2025 highlighted good growth in specific areas like USM leasing, that's used serviceable material, and engineered solutions. But they still missed on EPS that quarter. One other key event: back in March 2025, they announced a $45 million share repurchase from a major shareholder. That's often seen as a sign management thinks the stock is undervalued.
Okay, so a mix of news, but recently more positive, especially that Q2 beat. What about the professional analysts? Are they buying into this recent positive momentum?
The analyst community seems cautious. Despite the Q2 beat, sentiment has actually shifted more towards neutral. For example, Truist downgraded them from buy to hold in July 2025, lowering their price target to $6. And if you go back to August 2023, RBC Capital Markets had already downgraded them from outperform to sector perform, cutting their target from $20 way down to $15.
So recent downgrades or holds, even with some good news. What's the consensus view now?
The current average analyst recommendation is 3.0. On the typical 1 to 5 scale, where 1 is strong buy and 5 is sell, a 3.20 basically means hold or neutral, and the consensus target price is around $7. That's actually below the current market price of $8.46. So yeah, it suggests analysts are maybe acknowledging the recent improvements but are still wary, perhaps due to the historical volatility, the predictability issues, and maybe waiting to see if these positive trends are sustainable before getting more enthusiastic.
We've definitely covered a lot of ground on AerSale Corp today, from its really vital role in the whole aviation aftermarket ecosystem to this quite complex valuation picture, especially with that DCF warning, the pretty wild swings in financial metrics, and these mixed signals we're seeing from insiders and analysts.
It really is a compelling snapshot, isn't it? You see clear strengths in their core operations, things like asset management, USM leasing, and that recent earnings momentum is positive. But you also see a company dealing with market challenges, that tricky valuation situation due to predictability, and this history of performance swings. The conflicting insider moves just add another layer to that dynamic picture.